Good morning and welcome to this Monday, February 6th, 2023 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, it's a new week. Had a big run. Saw the Fed meeting last week. Got the quarter-point hike that everybody was expecting. Got a little bit of good news in the fact that the Fed recognized that inflation is in fact starting to come back down, and had a nice rally off of that. Got a big surprise on Friday when we had the non-farm payrolls come out. I think the expectation was for 187,000 and we were over 500,000. So those who are hoping for the Goldilocks scenario where all these rate hikes have no impact to the long-term health of the economy. Some of those folks, I guess, were pretty happy and the market rejoiced, and we saw pretty good action most of last week. But we did see what I would call a little bit of sell on the news on Friday. We had Apple report on Thursday evening, Amazon reported, Google reported, and we also had, of course, the Fed out of the way. And with all of that, of course, the reports that came out weren't spectacular. I mean, they were definitely a little iffy, if you will. And so as a result, I think we saw some selling on the news. So it was a buy on rumor kind of a thing where the market moved up throughout January, which was good, I think, for the year. We've talked about that, but January, I call it the January effect. Some call it the January barometer. I think it's more well known as the January barometer. I like to call it the January effect. But anytime you have a strong January, historically, the odds are stacked in your favor to have a pretty good balance of the year. So we got a great January. We got off to a good start in February. A lot of big news came out, and then we saw some selling on Friday. We see the futures down this morning. Let's see, last time I looked, NAS futures were down about 1%, maybe just a little bit more than 1%. Dow futures down a little bit more than 0.5%. S&P 500 futures down about 0.8%. Crude oil prices up about 1%, just over $74 a barrel. And the U.S. 10-year Treasury yield up 9 basis points this morning, 3.625%. So with all of that in mind, I think the market probably ran out a little bit of gas. Short term, I think there are some key levels that we'll want to watch. We'll get into a little bit of that in just a minute. But I'm going to go ahead and first take everyone over to Earnings Beats. If you are new to Earnings Beats, just want to let everyone know that we do have a free newsletter. Just go to earningsbeats.com, scroll down, you'll see it in the middle of the page. Name and email address, it's all it takes. No credit card, or you can unsubscribe at any time. 3 times a week newsletter, usually 2 paragraphs and a chart. Pretty simple read, but it does give you a quick little something before the market opens. Sometimes it's trading opportunity. Sometimes it's just a overall chart. Today, it's kind of one of those ratios that I like to follow, sustainability ratios, that has really started to turn back up again, which I think everyone should be aware of. So sometimes it's just educational content like that, just to keep you aware of what's going on, what's happening underneath the surface of the market, because it's the underneath part of the market that CNBC and other areas don't talk about. The media outlets don't talk about it very rarely. It's just cheerleading. It's bringing on all these so-called, with tongue-in-cheek, experts. I love it when they bring Peter Schiff on as an expert. All the guy does is bash the market every time he's on. He's right once a decade. Great. Well, that's great analysis. Anyway, if you do subscribe to Earnings Beats Digest, we'll give you some pretty good information, I think, throughout the week. Occasionally, maybe something to do with history. I'm going to talk a little bit about history today. If you didn't see my article at Stock Charts over the weekend, pretty good article, I think, on history and the way the market tends to perform. I'm a big fan of history. If you're not, you probably might not like the article, but I find a lot of a lot of valuable nuggets in history. I do a lot of research and I try to share some of the things I think are important. But if you haven't already signed up, Earnings Beats Digest, I think you'll find it very useful in your trading. Moving on to what happened on Friday. So we did see a down day on the market. Dow Jones Industrial Average, excuse me, down 128 points. S&P down 43, NASDAQ down 194. Mid caps down about 0.7%, and then small caps down about 0.4%. But overall, everything looks pretty good in the market. We've got the Dow Jones consolidating just beneath key resistance. We need to get a breakout, probably around about 34.8 or so to really get things going. So we've got another 2 or 3% there. S&P 500, though, did break out, took out that 4,100 double top from December. Also took out that reaction high back in early September at 4110. So that was really good news. If you're a very simple, traditional, higher high, higher low, or lower high, lower low kind of a technician, the S&P 500 needs to clear 4,300. That was the high back in August before we had the big drop into October. And now we have to get back through that 4,300. When that 4,300 level goes, I don't really see too much else from a technical perspective that really matters that much until you get back to the all-time high. So that's kind of what I'm watching, 4,300. 4,300, by the way, was also where the S&P 500 broke down from a Head and Shoulders top back early in the year, earlier in 2022, I should say. So those are some things to watch on the S&P. NASDAQ, beautiful move up off of the low in December, which almost reached the October low, almost had a double bottom. But January, huge month for the NASDAQ. And that is, that was something I talked about at the beginning of January. NASDAQ, that's the NASDAQ's best month, January. And once again, history comes through. Not only did we go up in January, but the NASDAQ easily outperformed both the S&P and the Dow after substantially underperforming in the fourth quarter. So what was a little worrisome became a big benefit to the market in January with the NASDAQ leading. Mid caps and small caps, again, trading really well, looking up. I love the AD lines, which have just taken off to the upside. It's showing a lot of buying throughout the day, finishing strong for the most part throughout the last 5 weeks. And that is set a fire on the AD lines. Among the sectors on Friday, all 11 were down. So I'm just focusing on the ones that were down the most. So we start with discretionary, down 3.08%. Utilities down a little more than 2%. Same goes with real estate. Communication services dropped exactly 2%, and materials down 1.8%. So we did have a couple of the aggressive groups that I like to follow, discretionary and communication services, both giving up some, but both looking pretty good on their charts. The key, once you turn around like this and start trending higher, in my opinion, if it truly is an uptrend, watch the rising 20-day EMAs. The huge move in January left us somewhat vulnerable in the near term because we moved way above the 20-day moving averages. So we could certainly see a pullback to those levels. I mean, for the XLY, we were up to about 158, fell back, closed Friday at 151.35. 20-day moving average rising pretty rapidly, but right now at 143.51. So price action right now is right between the recent high near 158 and the 20-day EMA at 143.51. Of course, futures down about 1% on the NASDAQ. I'm assuming discretionary probably will get hit, something around that area, 1% or so. So if we do, we're probably going to be dipping back down into the 140s. And as we get closer and closer to that 20-day moving average, the more and more bullish that I will grow in the short term. Let's move on to the 10-year Treasury yield. There were no economic reports out today of any significance that I saw. But again, we had the Fed meeting last week. We had the jobs report on Friday. So we got a lot of big stuff out of the way. We're very overbought in the near term. I wouldn't be surprised to see a little selling, but I also wouldn't be surprised to see the market just keep going up. So I'm maintaining my bullish stance. Short term, cautiously bullish, longer term, very bullish. And we'll talk a little bit about the history of the market in the shorter term, not so much looking at January versus the balance of the year, but I'll tell you about a couple other things here in just a couple minutes. 10-year Treasury yield, though, let me make sure I got the latest here, 3.63. So we are up about 10 basis points back through the 20 and the 50-day, by the way. So short term, this is the biggest jump we've seen, at least in 2023. So we'll see where we go. But as I said last week, what I was looking for, what I continue to look for, is a trading range here. I don't really see anything major so long as 337 to 340 holds on the downside and about 390 holds on the upside. Coming down, that is right now our trading range. Double bottom with that high in between serving as key yield resistance. So 337, 390. And right now we're at 363. We couldn't be much more in the center of this range right now. I know it's maybe a little bit disheartening to see it move back up above the key moving averages, but what I would say there is that when you go into a consolidation period, moving averages don't really provide that much support or resistance. So moving back up, unless we have a big reversal today and move back down, say into the 340s, I would be just viewing this as sideways consolidation. We move down in the short term, intermediate term, we're consolidating. Long term, we're still going up. We haven't done anything yet to confirm that the uptrend in the 10-year Treasury yield is done in the long term. And again, if you're one of those higher high, higher low kind of folks, technicians, well, there's your high, here's your low, here's your high. This is still well above this low. So we don't really confirm higher rates until we break out, and we don't confirm lower rates until we break down, and that's a wide range. I think we could be in this range for a while. My guess is if we break one end or the other, it's going to be the downside. I think later this year, we could see the 10-year Treasury yield moving back down toward 2.5%. I don't believe we're going to go back up through that 430, 440 area. I think that would be it would be a surprise for me. It'd be interesting to see how the stock market handles that if we did it. You would think off the top of your head that, hey, that would be horrible for the market. Probably would be, at least temporarily. Whether or not it resulted in a lot of accumulation, expecting another drop in the yields, I don't know. We'd have to kind of cross that bridge when we get to it. Moving on to the S&P 500. So here on the S&P, there's your breakout of that double top. There was the reaction high I talked about, 4110. So we got up to almost 4,200, pulled back. We closed at 4136. We're probably going to be close to that 4110 area on the open today. So short term, do we hold there? Or do we go down maybe and hit that 20-day moving average, which right now is at 4,023 and rising pretty rapidly. Any kind of a test there, I would be more aggressive, meaning maybe even leveraged ETFs. Don't know if we're going down that far, but as we approach it, that's where I would personally be a little bit more aggressive. If I was going to take a chance on the aggressive side, that's when I would do it, as you're getting closer to a key area where you expect there to be support. On the hourly chart on the S&P 500, here was that big move up. So I said there were a few levels to watch. We closed right on the 20-hour EMA on Friday. So it looked like, when I saw that, I was like, well, I don't know, maybe we move back up at the open on Monday. But if we don't hold that. A couple areas to look for. Number one was the breakout level right here, which was at about 4,090. That's the short-term breakout. So maybe intraday we go down to 4090. That would also get us close to that 50-hour SMA as it rises. So that would be one interesting area certainly to look for. The other would be the big move up that we had on Wednesday last week with the Fed. Remember, we broke out. We took off from, I can tell you right here, we were right at about 4,060. And actually, we'd probably see it even better on a 5-day, 10-minute chart. Yeah, right about 460. So there was 2 o'clock 4,060. You had a little bit of up and down, looked like we were going to go lower, and then we shot higher. So this whole area right here would become an interesting area because that's where a lot of the buying started for this latest rally. So hard to say where it goes. My guess is it's going to be a pretty shallow pullback. If I had my wishes, we'd get a little pullback here at the beginning of the week, and by the end of the week, we'd be back up near the highs, because the following Friday, not this Friday, but next Friday, is option expiration. And if we go into option expiration week near or at our highs, there is going to be billions and billions of dollars of net in the money call premium heading into that week of options. And that would make me very nervous for a week, or maybe a little longer than a week. But let's talk a little bit. I mentioned I was going to talk a little bit about history. So I want to talk a little bit about history here too. So first of all, if you followed me, you know that on the S&P 500, I'll go back to the daily chart. But on the S&P 500, since 1950, we have a very bullish part of the calendar month that begins on the 26th of the prior month and ends on the 6th of the current month. Today's the 6th. So we're coming to the end of a historically bullish period of calendar months, the way the calendar month normally unfolds. Now, February, I had mentioned to our members, and maybe I mentioned on the shows, I'm not sure, but January 26th to February 3rd is when we typically see strength, historical strength, in late January, early February. So it's not quite the same as we have during typical calendar months, but it's pretty close. And the 4th, 5th, and 6th of February are not horrible. They're just not what we normally would expect. They're a little flatter, maybe a little bit down. So that's historical fact number one. So we're running out of historical strength from a monthly standpoint, normal monthly market behavior. Month of the year, we sent out our seasonality report to members a few days ago. And February is kind of a weird month in that it's the second month of a quarter. February, May, August, and November are the 4 middle months of each calendar quarter. And what's interesting about the middle month of the calendar quarter, it's almost as if you can split it right down the middle. In other words, the first half of the month tends to be much more bullish than the second half of the month. And the first 1.5 months of the quarter is much, much more bullish than the second 1.5 months of the quarter. So February 15th is where we dissect this quarter right in the middle. It's going to be interesting to see, because I do think we're renewing this secular bull market. I think that's what we're going through now. I think we went through a period of distribution first 5 or 6 months last year. I'm going to call it manipulation after June, a lot of morning weakness followed by afternoon strength. So we just kind of churned, went up, went down, but mostly sideways action from mid-June all the way through probably October on the S&P, through the end of the year on the NASDAQ. And then we had the big surge in January. And I think this is starting a much bigger surge in 2023. But we're not going to go up every day. We're not going to go up every week. We're not going to go up every month. And so I am paying attention to the middle part of this month. Next week, obviously, is option expiration week. If we have a good week this week, that will take us right up to the February 10th. Next week, we'll start the 13th, getting pretty close to that 15th of the month, where normally we do not so great. And then also we have the second half of the quarter coming up, where we tend to struggle. So if we have that option expiration and the second half of the quarter to contend with, along with a big move up, overbought conditions, and maybe even, I don't know if we pull back and go back up, maybe a negative divergence sets up here. I don't think so. It'll probably be too early, but we'll want to be watching for that over the next few weeks anyway. Anyway, just some things to think about. I'm bullish but I'm cautiously bullish for the next 6 weeks, just because March tends to not be such a great month. February is the 11th best month on the S&P since 1950. If you know anything about your months, there are only 12 of them. When you're 11th, you're not very good. That's February. And in that seasonality report I sent to members, I produced the annualized return the first half of February versus the second half of February, and it's like night and day. So just be aware, all right, of that. Let's talk a little bit about the Dow Jones. So the Dow, of course, Dow components, there are 30 of them, and it's 921. I'm going to see how fast I can go through these. What I want to do, this is a longer term weekly chart that I want to go over on all of the Dow stocks. And I'm just going to look at it and I'm just going to say bullish, bearish, neutral, and maybe a quick synopsis of each. I think Apple right now is neutral, sideways consolidating off of an uptrend. I do like it longer term. It's made a big rally here at the beginning of the year. I look at maybe 125 to about 182 as a range. We're sitting kind of in the middle of it right now. So for me, this one's just neutral right now. Amgen, longer term, I like the uptrend. I actually like this pullback here. I think Amgen's probably a buy. Again, looking from a longer term perspective, I think the key level probably is around 220. We're a little bit above that, but our recent high 290. So I think Amgen with this pullback starting to look pretty impressive. Long term, I'm bullish. American Express struggled for a while, but that last earnings report, I think now maybe we're getting the rest of that right side of the cup to form. So I'm looking forward to go back up, test the high, and then we'll see from there. Boeing, I really like this one in the short term just because it's been going up. Obviously, it's going to have some additional overhead resistance, the biggest coming in at about 275, which we saw in March of 2021. Caterpillar recently broken out. It's had a pullback here in the last month or so, or well, last week. But I like it. I think overall it looks pretty good. I like it off that 20-week moving average. Salesforce been in a downtrend, but does have lower prices, higher PPO, and it's broken back up above the 50 moving average. So I think an uptrend's begun here. I think that bottom held from March 2020, and I think we're starting to trend up again on Salesforce. Cisco, break out above 50, and then we'll have something to talk about. That was kind of our support level on the way down. We've struggled to get through 50 on the way back up. I like the fact we held the 20 on the most recent pullback, that 20-day. So it's giving signs of a possible uptrend. A breakout above 50, 51 would confirm it. Chevron, trending higher, had a negative divergence right here, higher prices, lower PPO, but we went back, hit the 50-week, got close to the center line. I think now we're just sideways consolidating here. I'm going to say 160 to 190 is the range. So as it falls, if it gets close to that 50-week, the more I like Chevron. Disney, I think Disney is finally starting to turn the corner. Salesforce, you see the lower price, higher PPO, positive divergence. We've broken now through the 50. Any kind of a pullback, I like that rising 20-week moving average. Dow Holdings made a new high in May of 2022. Is this a cup? Maybe off of this uptrend. This actually looked like a cup, which executed negatively to the downside. So it negated the cup. So I don't know if I would go in and then call it a cup after a cup. That doesn't really make a whole lot of sense, but it is trending higher. So as long as it holds that rising 20-week EMA, I'm pretty good with that one. Goldman Sachs, I think, looks pretty good. I believe we're going to go back up and test that 400 level. Got some work to do to get through it, but I do like the fact that we're uptrending, bouncing off the rising 20-week EMA. Home Depot also trending up above the 20-week EMA. I think it goes back up above that 350 level and starts working its way back toward 400. Honeywell, nice rally in the fourth quarter of last year, now starting to roll back over again. I'd like to see it hold this 20 and turn back up again. So if we do see a pullback short term, maybe in some of the growth areas that have been so strong, one thing that would really help the market to remain afloat is if that money simply rotates to some of the non-growth areas, or maybe the more defensive dividend payers like Honeywell. So does it hold the 20-week? If it doesn't, watch for the 50 to hold. If it does hold, I think we're going to make another run for that 220 area. IBM still trending higher, but man, this thing is really hard to gauge. It seemed like it was breaking out in the fourth quarter last year, and then it came right back down. But it did hold the 50-week moving average, trying to turn back up again. Still has some decent relative strength versus its peers. I'm going to give it the benefit of the doubt and say the 132 area holds here. Intel. This is one of the worst stocks in the market. I haven't liked it for a long time. Even when it was moving up here in the beginning of 2021, look at what it was doing relative to the semis. So all you could say for it there was the fact that semis were strong and putting Intel on its shoulders and just carrying it higher. Intel wasn't doing any of it on its own, and it's still not. Still setting new relative lows. I don't like Intel. I think there are a lot of better semis to play. Eventually, maybe it gets its act together, but for now, I would ignore it. I would stay away from it. So that to me is a big bear call on Intel. Johnson & Johnson, I like this sideways consolidation, very defensive, very slow moving, but I think you are getting it down closer to the bottom of this range. So I actually like it here for a more conservative play with a decent dividend. JP Morgan, I really like what's going on. It started to show that leadership again in banking, which I think is really important. So after a pretty rough 2022, I think it's back on the mend again. I think it'll continue to trend higher and work its way back toward the all-time highs later this year. Coca-Cola, I think we're now into a right shoulder in this inverse head and shoulder. I think this is a really bullish pattern here on Coke. So there's your move up, left shoulder, neckline, lower low for the inverse head, right back to a very symmetrical right side of the neckline. There's your right shoulder. I'd be a buyer. A breakout above 65 measures to about 77 or so on Coca-Cola. So it's not going to be, not going to tear higher, but at the same time, looks like a pretty decent play with a nice dividend to boot. McDonald's been trending higher, sideways consolidating. I like this one. I think McDonald's is going to go higher. I look for it in the short term, maybe make a move back toward that 280 level, but ultimately breaking out. For those of you who believe that we are in a recession, just look at the restaurants. I mean, most of the restaurants have been doing pretty well. I don't see how they're going to do well in a recession, especially for those calling for a deep recession. 3M, downtrending. I'll put this one in the same category as Intel. Look at that relative weakness. Just can't get going. Stay away until it really has a meaningful uptrend. Merck. Hold on one second. Okay, sorry about that. Merck, beautiful move up on this weekly chart. Pull back to the 20-week. I think it probably is going to hold here. I wouldn't be surprised to see a little money rotate back into some of the defensive areas, especially as we move into the second half of this quarter. Microsoft, been downtrending, starting to turn around, but look at its relative strength versus software. So it's been going down mostly just because software has been horrible. Starting to strengthen, though. I think if we can get a definitive break up above about 265, 270, I think that would be a really bullish move for Microsoft. I like it, but we just need to see a little bit more out of the software area. Nike, I've been talking about how hot footwear is. I think there are some better stocks than Nike. I like Crocs. I like Deckers. I like both of those more than Nike, but Nike's certainly trending higher as well. As long as it keeps holding that rising 20-day, I like it. Procter & Gamble, sideways consolidation. This is a defensive stock, but it's been holding its own versus the personal products area. I think we're back down below the 50 and the 20. I'd like to see us get back up above it. So that's what I'd probably wait for. But if we do get above it, I'd be okay with it as long as it stays there. It's a good dividend payer, probably going to head back toward that 160 level. Travelers, I think, looks great. I love this pullback to the 20-week EMA. I see this one going higher. United Health, it's pulled back, doesn't look good, breaking below the moving averages, which it had not done in a few years. But I do like the fact that this is the key support area, and so far it's holding it. So let's say 430 to 450 key support. If it holds there, I think you're just seeing sideways consolidation before another move to the upside. Visa has really started to strengthen. I like Visa. I think anything back down close to that rising 20-week moving average looks good there. Verizon. Come on, Verizon. There we go. Verizon. It's bounced back. I think it's still got a lot of work to do. I don't know. That looks like a dead cat bounce to me. I could probably slap a Fibonacci on there, not be too impressed. Not doing well versus its peers. I don't know about this. I've got to see it at least get through the 50-week. That could just be a 50-week test before it rolls back over again. Same goes for Walgreens Boots Alliance. Just gets up to the 50, rolls back over again. Downtrend, relative weakness. I can't really endorse that one. Walmart, I think this is your last one, been moving up. I think it's established very key support level down below 120 back in May of last year. The move to the upside and the highs, I don't think that was a real high there, but maybe. Anyway, I think 158 to 160 is where you got to watch Walmart to the upside. It's in the range. I see it going higher, but it's got, in order to confirm it, we're going to have to get that breakout above 158, 160. All right, that was a quick trip through the Dow 30. Market has just opened. So what I'm going to do is just give you a quick look at what's going on here, and then we're going to wrap this thing up. NASDAQ off of its earlier lows. We talked about it was down around 1%. So now it's down 0.71. Not bad. Dow down 0.31. Yeah, I mean, market is showing a lot of strength. And I was looking at the manipulation calling bottom for the last several months, but this is how you get confirmation. The signals are all nice. And trust me, I got criticized a lot. I got criticized at the beginning of the year when I said the market was going to go down because people want to hear what they want to hear. And when the market's going up, they don't want to hear that it's going to go down. And in June, when I said the bottom was in, and in late September, when I said we're getting a double bottom, great chance to get in if you missed the first time. Everybody who's bearish, of course, they're not going to agree with me, so they don't like what I have to say. I get it. But I call what I see. When I see manipulation by Wall Street taking advantage of individual traders, I'm going to call them out on it. You can agree with me. You can disagree with me. But I believe this market has confirmed what I was talking about the second half of last year. And I believe we're going higher. It's just a matter of whether in the short term, you know, do we sideways consolidate? Do we have a little bit of a pullback? If we're going to, the next month and a half is where you're likely to see it. I think going into April, we are going to be soaring as we head toward the next earnings report. We'll see what happens. Anyhow, everybody have a great day. Have a great week. And I'll be back tomorrow over at Stock Charts TV for your next Trading Places Live episode, although that is technically a recording. But at 9 o'clock tomorrow morning, just click on Stock Charts TV. You don't have to be a member there. Just click on that. You can come in and listen to the show. And then, of course, on Wednesday, you can always come in here. Mondays and Wednesdays, you can always come into this room, listen to me here at Earnings Beats. If you go over to Earnings Beats and click on Trading Places Live, you'll have the Listen Live button right there. Just click on it and you can come right in. Usually that's set up around 8:45 in the morning, about 15 minutes before the market opens. Anyhow, have a great day, everybody. Happy trading.